Hey there, welcome to Kneppy Invests USA. So I've throughout my investing journey, I've really only invested in the ASX or on the ASX. So any companies that's been listed in Australia, those are the companies I've invested in. I've been thinking about investing overseas for about 5 or 6 years. I've never taken that final step. And I think it's time in my investing journey to take that step. It's also quite exciting because I've started to research some of these companies across the world, and I'm finding some of these companies quite fascinating. I was listening to a podcast a few months ago, and they just mentioned in the podcast that a few companies should be in your core portfolio. For example, I think they said Apple, Amazon, definitely not Tesla, but Microsoft, that's another one. But I decided just to have a look at some of these companies to see if they truly should be a core holding in Kneppy Invest portfolio. So first company I'm going to be looking at today is Apple. Is Apple a buy for Kneppy Invest? So let's have a look at Apple. So first thing I'm going to do is go through the charts, and then I'll go through financials and then make a decision whether I think this company is a buy for me. Just because it may or may not be a buy for me doesn't mean it won't be a buy for you. We all have to make our own investing decisions based off our own particular investing habits or whatever. So anyway, so let's get into it. Apple. So when I looked at the 15-year weekly, the thing that really struck me is it was going through a really nice uptrend from around about 2009 all the way up to 2017. A really good linear uptrend, but it's gone exponential in the last 3 or 4 years. Typically, that's not a good thing. I don't like to see any sort of pricing chart go through an exponential growth like this. It's usually harbinger for potential bubble territory, and you always see bubbles go through this exponential growth in their price, whatever the bubble is. And that's my first concern when I look at this chart for Apple. This is the weekly chart. So if I go zone in and just look at the daily chart, we can just see the share price at the just pre-COVID, it got to a high of about $80. Now this is they did do a consolidation, I think in August. So this is using data taking into account the consolidation. So even though it says the share price was $80 in pre-COVID, the share price was actually higher than that. So this is just adjusting the share price based off the consolidation. So anyway, share price was about 80, and then it fell back to say $55 or so, and then it just went straight through the old high and just kept on going up and up and up. First thing I look when I see this is just over exuberance with people buying Apple and not really understanding that there's no reason for it to be almost double the price before it was during the COVID-19. That's just ridiculous. It doesn't look like it's forming a symmetrical triangle the last few months from that high of about almost $140 in September. So a symmetrical triangle could be a little bit bullish if it breaks to the upside, or maybe it could even be bearish if it breaks to the downside. So I'm actually not too excited with either chart, just because the exponential looking chart in the weekly, and then this one just a bit of a symmetrical triangle. So at this stage, not that interested in Apple just based off the charting. Now let's look at the financials. So I've just got 15 years of data here just to see how it's going. So the main thing is Apple released the iPhone in 2007. I want to say August 2007, definitely 2007. But because the iPhone was released then, and it's probably been their most successful product, so I'm just having to guess there, but I'd say that's probably true. We more than likely would have seen substantial revenue growth, profit growth, operating cash flow growth from 2007 all the way to at least 5 or 6 years after that, and that's what we do see. We've also seen shares on issue or shares outstanding have been going backwards the last few years. That's because they've been doing some share buybacks. So when it comes to capital allocation, share buybacks is one thing management can do to allocate the capital or excess capital they have on hand, and Apple sure did have excess capital with, hundreds of millions, perhaps even billions of dollars in cash. When I look at the PE ratio, and the ratio that I like to look at the most, which is enterprise value over operating cash flow, I should give that a name so everyone knows what it is. But both of those at historically high levels, which is also a bad name, or bad thing. So If you go back into the past, the last time they were at these levels was in 2006 and 7 before the GFC crash. We saw really good valuations between about 2011 and 2016. That would have been a really good time to buy. And I'm pretty sure that Buffett bought Apple in around 2016 or maybe a little bit before then. So we did see a PE ratio get down to less than 12, and my EV operating cash flow ratio, which for value plays, and Apple's not a value play, I like to see numbers less than 6. Or in cases like Apple, I like to see numbers less than 10. And it got as low as 7.55 in 2013. Right now, PE ratio is at 36 and EV over operating cash flows at 25. Those are pretty high, relatively speaking, for Apple, which means or suggests that it's probably overvalued. The last thing I just noticed here when I looked at this is the lack of growth in revenue, profit, and operating cash flow the last 5 years. And that's a little bit concerning, especially when you look at the share price growth over the past 5 years to go along with that. We've seen rapid share price growth, but not a lot of growth, if any at all, in some very important metrics. So operating cash flow for me is the most important thing to look at when judging a company's worth. So we actually haven't seen any growth at all. And we can actually see that in this graph here. This goes back, taking all that and just graphing it out for 15 years. And on the right side there, I've got the CAGR, which is the compound annual growth rate of revenue, profit, operating cash flow, and the share price. So I've got 15 years of compound annual growth rate and 5 years. And 15 years looks pretty good. So revenues compounded at 21%, profit at 27%, operating cash flow 29%, and share price is 31%. So typically I want to see is operating cash flow, if it's going up 29%, that's about what I want to see the share price increasing. So when I see those two numbers being the same or around the same, that's a good sign that the market's judging the company or valuing the company fairly well. If I see the share price compounding at a much lower rate than operating cash flow, that will scream out value. And if it's significantly higher than the operating cash flow percentage increases, I would say that the market is starting to or tending to overvalue the company. And when we look at the last 5 years, we can see that lack of growth in revenue, profit, and operating cash flow. Instead, in fact, operating cash flow is just being sideways. But we've seen the share price grow at 33% per year. And that, to me, straight away suggests the market is really overvaluing Apple, unless the market believes or thinks that Apple is going to experience significant financial growth or revenue, profit, and operating cash flow growth in the next 5 or 10 years. So we really need to see that moving forward for the share price to have justified growing at 33% over the last 5 years. I'm not sure they're going to see that. And this also shows, this financial ratios just shows that right now we're seeing the PE ratio, price to book, price to sales, and my favorite ratio, or at 15-year highs or near 15-year highs, suggesting that Apple is starting to be overvalued by the market. Some downsayers would say, I'm not taking into account the interest rates, but even take into account the interest rates, we're not seeing any growth. And for interest rate to play a part, you need to see growth in the underlying company. So I could be wrong in the end, but I think when I get to the next slide, I'll just show you some things. But one other thing I like to look at when I look at the financials of a company is to see how they're doing across the world and how they're doing in their individual segments. So across the world, in fact, China, they're going backwards the last year or so. Now that's the top graph here. So that's just kind of showing you America, Europe, Greater China, Japan, rest of Asia and Pacific. Not much growth in any region. Maybe Europe could be the best growing over the past year or so. But in the bottom one there, you can see sales by category. So we've got iPhone, Mac, iPad, wearables, home accessories and services. We've seen iPhones gone backwards in the last year. Now, more than likely, that's because Apple have just released their new iPhone. And I think the market, or a lot of people would have been waiting for that release of the new iPhone before they buy some. So I would suggest that we will see some growth in sales in the iPhone segment over the next few quarters, just because of the release of the new iPhone. And we have seen some good growth in Mac, iPad, wearables, and even in services. And services is becoming their second biggest segment. And I'll suggest probably the services probably has the best margins as well. So will I invest in Apple? So no, that's the simple question or simple answer here. And the main reason is because the lack of growth in the underlying business during the last 5 years. And even though we have, just because we would see a lack of growth in a company over a 5-year period, doesn't mean I would eliminate that company from buying in, but the share price for Apple has gone up 33% per year in that 5 years where we've seen no financial growth, which again is a big red flag. So the share price has been driven by multiple expansion. So when I see the share price being driven solely by multiple expansion, I probably also should say here too, the share buyback has probably helped with the growing share price too. So we've seen, if you see the shares on issue going down, even though the share price could remain constant, even though financials are constant, we still should see some share price growth because for each person holding one share, you're getting a little bit of a bigger pie, slice of the pie, if that makes sense. But anyway, most of the share price growth has been driven by multiple expansion, not financials or not even by share buybacks. I like to see the opposite. I like to see share price growth being driven by financials instead of multiple expansion. Both can happen simultaneously. You can see share price growth being driven by both multiple expansion and financial expansion. And sometimes that's where you see the greatest growth in the share price when both of those are happening. Now, in my opinion, Apple needs to have some really innovative new products, not just releasing a new iPhone. That won't do it, I think, for the long term. So I think in the next 5 or 10 years, they need to have or develop some really innovative product for the world's use. And that's what might drive increases in their cash flow and revenue. There is potential just because the share price has risen by 33% per year over the last 5 years, that the market will correct itself and we might not see much share price growth over the next decade just because we've already seen that share price growth based off the multiple expansion and the financials have to catch up, and it can take a while for the financials to catch up. I believe that Microsoft went through this about 20 years ago. They went through multiple expansion and then it took a while for the financial expansion to catch up to the Microsoft share price. And that's unless there is some sort of innovation again, so innovative products that can really give rise to a financial expansion or quite significant financial expansion. So we might see share price growth be very small unless there's that significant financial expansion to justify the share price growth. So in my opinion, without even looking at any other companies in the United States, I think there's probably going to be better opportunities elsewhere. And probably the only other thing that might see me buying is if we see a significant drop in the share price, and I'd say at least 50% from here. That might get me a little bit more interested because I'd have to have a bit of a discount to fair value just to buy into Apple at this point in time, sort of a safety margin, if you will, just because the lack of financial growth, and I'm not sure they'll see significant financial growth over the next 5 years. So if that's the case, I'd like to have a bit of a margin of safety there if the share price does drop. Doesn't mean it will drop, but if it does drop, I'd still like a bit of margin of safety before I even think of buying in. So that's all I've got on Apple for this episode. So if you are an Apple shareholder, leave a comment. I could be wrong. You could have differing views on Apple, and I'm always willing to take those into account. But at this stage, Apple is a no for me. Tomorrow or the next episode on Kneppy Invests USA, I want to look at Amazon. I did not expect Amazon to intrigue me when I looked at it, and it is definitely intriguing me. So hope you enjoy me for the next episode, which I'll be looking at Amazon. I am not a financial advisor, so make sure you speak to someone who is an expert in their field, who has qualifications, who would be able to help you in your own financial circumstances. Otherwise, have a good day. I'll talk to you later. Bye.